What's up everyone? Welcome back to Mike and his whiteboard. My name is Mike. This is my whiteboard, and if you're brand new to this segment, we break down concepts and we construct them visually for you. So we've got over about 65 episodes now. So if you missed any of them, definitely check them out at the top. Go to Find Shows, scroll down to Mike and his whiteboard, and you'll see all of them there, ranging from beginner option concepts to intermediate strategies. We've got them all for you. And today we're going to step back a little bit and take a look at a beginner strategy, and it's the calendar spread. So we're looking at the calendar spread and different scenarios we might use this in. We're going to take a look at the risk profile graph. We're going to see how it works and what we can calculate from it. So let's get right into it, and we'll break down exactly how we construct a calendar spread. So right here we can see that a setup in a calendar spread, for an example, we've got a strike price of 100, as you can see here. And basically a calendar spread is the combination of a long option in a further dated expiration with the combination of selling that same strike, same option in a near-term expiration. So in this example, we're looking at purchasing the April call at the 100 strike, and we're looking at selling the Feb call against that on the same exact strike. And what we're going to find is that calendar spreads are going to be routed for a debit, which means that the most I can possibly lose on this trade is the debit I paid for that. So as we know, with a long call, the max profit is going to be unlimited to the upside. We know that we're paying for this option, so my break-even point is going to be way over here. It's not going to be really anywhere near the strike price because of the fact that if I pay for an option to hold that right to buy 100 shares of stock at a certain strike, whatever I pay for that, I have to add that value to the strike price to get my break even. Because at the end of the day, at expiration, if I pay $5 for this option, I need to sell this option for $5 to break even on that trade. And the only way I can do that at expiration is if this strike is 5 points in the money. So in that example, if I've bought the 100 call for $5, I would need this little blue thing, the stock price here, to go up to 105. So that's my break even point. But since I've got no cap to the upside, I've got unlimited profitability with just this long call here. However, when I look at just a short call, it's the exact opposite. As you can see, my profit is to the right on this strike bar with a long call, but my profit is to the left with a short call. As we know, with a short call, we can profit to the tune of whatever we collected in premium for that. So in this example, I'm looking at a February call, and regardless of what that value is, my profit is going to be to the left of that strike bar. I want that stock price to go down when I'm looking to sell the call, and that's going to leave that call out of the money, which is going to allow me to keep the credit I received as profit at expiration, because as we know, options cannot be exercised for anything other than intrinsic value at expiration. So when we look at these two separately, we can see the different basic profiles and the risk graphs associated with them, but it gets a little trickier when we actually combine these two options. So let's go to the next slide and we'll take a look at what that looks like. So when you look at a calendar spread risk profile, you're going to see a little something like this. So we know that we paid a debit for this, so my max loss is going to be down here. So if you can imagine the vertical or the horizontal strike here as being our break-even point, we're looking at basically a profit or loss along this line. As you can see, my max profit is going to be received if the stock price is right around the strike price at expiration, and it's going to be most important and most helpful if volatility in fact increases. And we'll talk a little bit more about that in just a second. But as you can see, the risk profile graph flattens out to the right and flattens out to the left. So we're going to talk a little bit about why that is. So let's say the stock price ends up drifting all the way to the left. So we would have two out of the money options, both which would expire worthless. However, we did pay a certain amount for this option. We paid a debit for this spread because we know that if I'm buying an option further out in time and I'm selling an option to reduce my cost basis against that, regardless of whatever I'm selling this option for, this longer option is going to have more value. If we think about it in terms of life insurance or car insurance, the longer time frame I'm insured for, the more premium in total I'm going to have to pay for that. It's the same thing here. If I'm selling an option, it's going to be worth less than another option I'm buying that has double the amount of time or triple the amount of time or whatever it is. Because of the fact that with the long option, I have much more time to be correct, and for that, I'm paying more of a premium to do so. So if the stock price goes all the way down to the left there, we know that I paid a certain premium, I paid a debit to execute this calendar spread. So if the stock price goes down and these options are completely out of the money, I would lose that value, and that's the most I could possibly lose. However, if the stock price goes up, it's a little bit different. So we know that we paid a debit for this spread, but if the stock price goes up too far, it can in fact become a full loser. And that's because of the fact that I've got the winning option here, so my long call would definitely show profitability on this trade. However, my short call at the expiration of this expiration is going to be capping my profits on my long call. So we know that there's intrinsic value associated with in the money options. So whatever my intrinsic value profit is on this call, it's going to be offset by intrinsic value losses with this short call. So the further away we go from the stock price on either side here is going to result in a loss. So that's really important to understand with calendar spreads. And that's why we consider these to be pure volatility plays. So let's go to the next slide and we'll talk a little bit about how we can calculate some things with this spread. So I've got some examples here with some prices. So let's say I went out and I looked at the April calls and I'm looking at purchasing this call for $7. As you can see, it's just out of the money, and I'm looking at selling a February call against that for $2. As you can see, as we were talking about before, the pricing in the Feb call is much less than the April call because the April call has more time associated with it, and therefore it must be priced higher than that Feb call. So the net cost here is a $5 debit. If I'm paying $7 and collecting $2 in premium to offset my cost basis and increase my probabilities on this specific trade, then my overall result is going to be a $5 debit. So let's take a look at the bottom rows here. So we've got max profit listed, we've got our break even listed, and we have our max loss. So the only thing I have filled in here with this specific spread is the max loss. And that's because of the fact that we have a long option in April that has a different expiration than this Feb option. Now, if we were to look at the intrinsic value of both of these options at the Feb expiration, we can probably come up with a rough estimate of what our max profit might be and what our break even might be. But because of the fact that we're going to have this long April call at expiration, especially if this February call expires out of the money, it's really hard to determine our break even and max profit. So let's talk a little bit about why that is. So if we've got our April call at the 100 strike that we talked about before, let's say the stock price is at 99 right there, and we've got our February call on that same exact 100 strike. Let's say that implied volatility jumps up 20%. So the stock price doesn't move at all, but something has happened within the market and option prices are increasing for whatever reason, which is going to result in an increase in implied volatility because at the end of the day, implied volatility is just a reflection of what's happening in the option market prices. If the prices are being bid up by a lot of activity and a lot of buyers of those options, it's going to reflect in an increase in implied volatility. And vice versa is true if implied volatility is decreasing. If we see that the IV is decreasing, it's indicative of option prices decreasing as well. So people might be selling a lot of those options as opposed to buying them. Regardless, let's say our volatilities increased 20%, but our stock price has not moved at all. So what would happen at expiration? Well, we would probably see a marked loss for sure on the February short call. As we know, if we sell an option at a certain value and implied volatility is increasing, which is indicative of option prices increasing, we're going to see a marked loss on the February option. However, at expiration, we can exercise and the option is going to be worth the intrinsic value. For 1 minute before expiration, it's going to be trading for pretty much fully intrinsic value. And as we know, anything above the stock price with calls is considered to be out of the money. Why would someone buy shares at a higher price with a long call when they can just buy shares in the market for a lower price? They wouldn't, which is why it's considered to be out of the money. So if we know that we'll see a marked loss if implied volatility increases throughout the life cycle of this trade in the Feb call, what's going to happen at expiration? All of that marked loss is going to disappear. The Feb call is going to disappear as well. I'm going to be left with that $5 net debit price, but I'm also going to be left with a long April call worth a certain value. And because of the fact that we can't predict what implied volatility will be and how that's going to affect this certain option, because of the fact that we can't predict the implied volatility, we're not going to really know what our max profit is. And because of the fact that we're going to have that long call, and if our short call expires out of the money, we're left with a long call with an unknown volatility value until we're actually at that point. So we're not going to be able to really know what this call value is going to be worth. Maybe it'll be worth a little bit more. Maybe too much time would have passed where it'll be worth the same value. But even in that case, if I can go ahead and sell this call for $7 if it's worth the exact same value, it's still a profitable trade because this Feb call would have expired out of the money and worthless for $2. I would have paid a $5 debit, and now I can go back into the market, sell this call for $7, and that would net me a $200 profit or a $2 profit in the options world. So it's really interesting to consider what the possibilities are with calendar spreads. But let's go to the next slide and we'll wrap it all together with some takeaways for you. So the very first takeaway is super important, and it's the fact that a calendar spread is an IV expansion play. You'll see Liz and Jenny route these a lot when the volatility in the markets and volatility in certain underlyings is really, really low. Because we're looking for an IV expansion, we want to usually get into this trade when an IV environment is super low. That gives us the ability to have an assumption that IV might increase in the near future, as we've shown that IV does have some mean reverting properties. Next on the list is put versus call calendar spread. When should I use one? When should I use the other? Well, for me, I like to consider what I'm more comfortable with being out of the money. So if I'm more comfortable with the stock price dropping and having my strikes be out of the money or stay around a range where I'm holding some call calendar spreads, then maybe I'd look to do a call calendar spread. Or maybe if I assume that the stock price might drift up a little bit in the near term, maybe I'll go with a put calendar spread. The cost should be roughly the same when you're looking at the difference between the put versus call calendar spread. While there is a volatility skew in most underlyings where the puts do trade richer than calls when you're looking at just out of the money options, it's still it's basically going to be roughly around the same price, so there shouldn't be any true arbitrage value there. So really, I would consider what you're more comfortable with in terms of being out of the money with, whether that be calls with the stock price drifting down to the downside, or with puts where the stock price might drift up to the upside a bit. And lastly, IV change affects longer dated options more. I was talking about that marked loss in the February call, but when we're looking at IV expansions, yes, we will see a marked loss on the shorter term call because we sold it at a certain value in a low IV environment. And if IV increases, I'm probably going to see a marked loss on that. But since IV change affects longer dated options more, my profit that I would see on that long call is going to offset the short loss that I'm going to see on that short option. So there's going to be a greater gain on the long option than I would see in my short option that I would see a loss in. So basically the difference between the two is going to create a profitable scenario if IV does expand. So this has been an overview of a calendar spread. Thanks so much for tuning in. Hopefully you enjoyed it. If you've got any feedback or questions at all, shoot me an email at support@dough.com. Or you can shoot me a tweet at DoughTraderMike. Until next time, we will see you again, but we've got Shadow Traders up next, so stay tuned.